I've been advocating gold and silver for some time. Probably gold and silver would take up 20-25% of the portfolio.
Right now?
Right now.
Wow.
This is something that we keep telling retail investors also who want to be good investors. Start by looking at the cash flows. Try and understand that. If you think India has to grow, our favorite segment where we would like to focus on would be wealth management companies. I think that's a segment which we believe will do very well.
So looks like I've set up the right business. Wealth
Absolutely,
management.
absolutely.
True alpha comes from an information arbitrage. How exactly do you identify this information arbitrage in the market so that you can ride that upside?
This is a brilliant question. Okay. I'm still staying on rent.
Okay.
It makes a lot of sense today.
Wow. You're
But
50 years old,
Yeah,
you're staying
still-
on rent.
yeah.
And you are a CIO.
But of late, I've just crossed 50, so my wife made me realize I need...
That's the same answer I hear from every CIO who has come here.
Okay.
My wife finally told me you have to buy a house, so now I bought a house.
If someone really wants to build wealth in India in the next 10 or 15 years, we believe...
Hey guys, welcome back to another episode of the 1% Club Show. On today's episode, I have Mr. Aniruddha Naha, who is the Chief Investment Officer of PGIM AMC. He is someone who has upwards of 22 years of experience in the investment management space. Today, I'm sitting here with him to understand how you should invest your money in 2025 and for the upcoming 2026 year. Mr. Aniruddha, thank you so much for coming on our show.
It's a pleasure. Pleasure. Thank you for having me over here.
So Aniruddha, as we were speaking, when you were working, and you're currently working in PGIM right now in the alternate investment space, which includes PMSs and AIFs.
Right.
But just a while back, you were working in the mutual fund space as well.
Right.
And you told me that when you joined, the AUM that you were managing was almost 1,500 crores, which was in 2018.
Absolutely.
By the time you left, which is in 2023, the mutual fund division, it had already reached 22,000 crores.
Right.
So that's almost 15x growth of AUM, right, during your tenure.
Right.
So my first question is, what exactly did you do right in that period from 2018 to 2022, 23,
Right.
when the money that you're managing became 15 times? Something you did right. What was it?
Sure. So firstly, again, thank you for having me here. We've largely been focused through and throughout in our investment philosophy. We start off with, being very sure about what not to do. Once we are sure about what we don't do, it just eliminates a lot of mistakes. And that helps through and throughout cycles, actually. So what we do focus on, of course, growth. India is a growth story. It's a emerging economy, probably the place to be invested into the next 5-10 years, okay, if not longer. But what we also realize is during cycles, there are lots of bubbles which get created. If you can avoid making mistakes in a bubble, or if you can protect the downside, I think that is something which really stands out. I think 2018-19, initially we were just floating around doing reasonably okay. I think 2020, the COVID year, was very transformative for us because it was a bet where the markets had really corrected. Valuations were on your side. I think the rhetoric or the thought process in the market was things are only going to go down. We bet on the fact that the world will come back, and we accordingly built positions. We were reasonably conservative before that. We made the portfolios reasonably aggressive at that point of time. It is very difficult to buy into falls.
Yeah.
If you can do that, I think, and that's something that we did. We always as a team keep looking out for such falls. And that's where we went ahead, created a good, strong portfolio based on cash flows. And I think so that fructified over the next 3 years.
Got it. So basically doubling down when the market corrected, when a lot of people were panicking and pulling out their money.
Right.
You bet on companies which had good cash flows and you knew that they were undervalued. So and you invested in them.
Absolutely.
Now, one more thing, Aniruddha, is what I've come to realize, that true alpha, which is basically outperformance with respect to the index, comes from an information arbitrage, meaning that you are figured out something before the rest of the market has done.
Right.
Because if everybody knows it, which means, for example, everybody knows AI is the next big thing.
Hmm.
If everybody knows it, the whole world is going to put money into it and it's just going to go up.
Right.
But true wealth is not created like that. True wealth is created when you know something before the rest of the world, because the price has not been reflected based on that knowledge yet.
Sure.
So based on that understanding, how exactly do you identify this information arbitrage in the market, right? How do you sort of understand things about certain sectors or companies before it becomes common knowledge so that you can ride that upside?
Sure. This is a brilliant question. Okay.
Thanks.
Now, let me put it this way. Information arbitrage might not sound right. Okay. But let me put it this way. Just pure, analysis of sectors and companies is what we do. I'll come to the point. See, what we like to do is we like to buy into good businesses, and I'll define what is good businesses, which are going through tough times. Okay. Now, what are good businesses according to us? They have a history of cash flows. So they have generated cash flows through and throughout. Okay. So it is possible that the profits are depressed, but cash flows are still happening. Okay. This is one. Secondly, the balance sheets are reasonably clean. The good thing about corporate India is today the balance sheets generally are very clean, in terms of not having too much of debt. Okay. So that is the second thing that we look for in a good business. Cash flows followed by good clean balance sheets, followed by good promoters. Okay. And there we do a lot of work. Once these three things get ticked off, we like to see such businesses which are going through tough times. So to give you some sense, today, if you ask me, okay, Aniruddha, where is the space where you think, businesses are going through tough times? I would say chemicals probably. Okay. I would say probably auto anchs. Okay. Textiles went through its own phase when, all the tariffs came through. So at that point of time, generally people are skeptical about such businesses. But if these businesses have proven good cash flows, clean balance sheets and good promoters through and throughout the history, it becomes a very high probability event that if you invest in them today with a view over the next 3 years, you will make reasonable amount of money. At the bottom of a cycle, what happens is the prices are depressed, earnings are depressed, valuations are also, so people don't care about them. If you buy them then, the ROEs are also depressed, the return on equities. But if you buy them then, what all plays out in the next 3 years as the cycle turns, the earnings come through, you also get the second component which is important for return, which is PE expansions happen and ROEs start moving up.
Can you explain what is that PE expansion?
Sure. Okay. So returns generally, according to us, and this is our belief, the overall returns that a person makes or a stock gives, it has two components playing out there. One is there has to be earnings growth. Okay. So if the earnings grows from 15 rupees to 20 rupees for a company, accordingly the stocks will move up. Okay. But what happens is, let's say at 15 rupees, the stock is about 10 times. So the stock price is 150, right? Now, when the 15 goes to 20, if it is out surprising people on the positive side, let's say the expectation is 18 and you deliver 20. Okay. So what should ideally happen? The 20 should be into the, what was the P that we took at the first? 15 into 10, right?
Correct.
150. So 20 into 10, it should be what the P should, the price should be 200. But people realize that the earnings have started accelerating. They will say that I am ready to give 12 P to this. So suddenly, what happens where 150 stock actually doesn't go to 200, it goes to 240 because there are two components, earnings growth as well as a PE expansion playing out. The PE expansion happens from 10 to 12 and this could keep going on.
But why does PE expansion happen?
Because there are positive surprises which come through. The P compression happens because when there are negative surprises. Okay, that's a sentiment value that is being attached. Okay, when suddenly earnings start outperforming the expectation, there is a lot more money which chases such stock because the trajectory or the expectation of outperformance or the company to keep outperforming is very high. And hence people say, okay, why shouldn't I only stick myself to 10p? Let me go up to 12p because we believe this earnings which has come through of 20 might actually overshoot again into the next 2 quarters, 3 quarters or 2 or 3 years. And that's why the PE expansions happen.
So basically the speed at which it is growing,
Absolutely.
the earnings, so that has surprised people.
Absolutely. It has to be a positive surprise for a PE expansion and generally a negative surprise would see PE compressions happen.
So you said that you like to look at good cash flow companies in troubled sectors?
Trouble sector, or the company specifically might be going through some amount of a trouble or whatever.
You identify such companies, and how do you know by when they will turn around? Isn't that
So-
like a difficult thing to do?
So that is frankly what we get paid for.
Huh.
Okay. So we need to meet these companies.
Like if you had to tell your, let's say, your 10-year-old son, for example,
Right.
how would you explain this? What do you do?
See, what we basically try and do is we do a lot of ground research. Okay. Me and my analyst.
Okay.
And I'm sure this is the thing that goes across different fund houses.
Okay.
You meet distributors, dealers. So how do we assess a company? You take the company around. First is, of course, we try and assess the promoters. Because we are minority shareholders, is his interest aligned to our interest or not? Okay. Once that is established, then we try and triangulate the company, keep the company in the center. Who are the suppliers to the company?
There's one question
Yeah.
here. So when you meet the promoter, don't you think they're very good salespeople? How will you find out if they're lying?
So meeting the promoter is the last thing we do.
Okay.
Okay, that's a box tick off that happens, but that's the last thing we do. You're absolutely right. A promoter would generally not give you, I'm without any bias, but they would probably give you a good picture about how things are, and the reality might be a little different from that, or very different from that.
Sure.
What we do is, that is where the channel checks go through, and that is a channel check on both the company, and also it vindicates what the promoter has been saying, let's say on con calls, or probably on earnings calls, or the annual report, what is it saying?
So can you give an example of a company without naming it and tell us exactly what sort of groundwork you did for this company?
Sure.
To identify some kind of, outperformance which other people have not seen.
Sure. So generally I'll take a sector like jewelry.
Okay.
Now, jewelry is a sector where there is a lot of unorganized guys. Okay. And there are few large organized guys. So there was a time when there was an IPO for a small company based out of Gujarat. They were doing B2B work largely for the largest listed jewelry company in India.
Okay.
Now, when initially, frankly speaking, we didn't even want to meet them, but it was the persistence of the promoter. We said, okay, let's meet. Okay. We initially had slotted it for 1 hour. The meeting went on for 2.5 hours.
Okay.
Young gentleman, he was extremely confident and very convincing. Now, we started meeting the promoter. Then we said, okay, let's do the channel checks. So we started doing our channel checks with the jewelry company for which he supplies into, and he supplies B2B to probably four of India's largest jewelers. Okay, so when we spoke to some of these companies, they spoke extremely highly about these gentlemen. Okay, so that was the first vindication where these branded guys who are so well respected speak so well about a very, very small company coming out for an IPO of 500-600 crores market cap. Okay, so that was the first check. The second check was walking into their store in Ahmedabad to figure out what they do. Without announcing us, me and my analysts, we were going down there. They wouldn't bifurcate their bills. So every bill was, if it is above 2 lakhs, you have to name your you have to give your PAN card. You want to see whether, there are shortcuts out there. No. So some of those checks and balances, then how they're designed. Their designing is what actually made them go very well with some of these larger brands. We've checked out the full team sitting out there, and very convincing guys. New jewelry. In fact, the largest jewelry company, lot of the female population wouldn't go to them for marriage jewelry, etc. That actually turned in the last 4-5 years, largely because of them outsourcing it to some of these guys. And those were some of the checks and balances. Then you check, even within our society or etc. Do you actually end up buying jewelry from these brands? And the answer was yes. So those were some of the checks and balances. Of course, we have got chartered accountants, CFAs sitting in the team, running through all the numbers that are required. We also finally have the, the liberty of getting a forensic audit done if required, where we like the business but are not sure about everything. where we want to be extremely sure, we will go ahead and get a forensic done. This is where probably we differentiate, where a retail guy wouldn't have that access. But that is the access as an organization or an institute we bring to the table.
Man, this is like super detailed kind of research where you go into the ground level, meet the promoter, meet their distributors, go to their factory, ask questions to the employees.
Absolutely.
So much of research.
Absolutely.
That's very in-depth. I didn't know it was like so much of work. I thought you just look at the P&L and then you go and invest, right? Because that's what retail investors can do to the greater extent. Sure. We are limited to the financial reports.
See, so our view is when we look at numbers, let's say, forget everything else. Even when we look at numbers, and this is something that we keep telling retail investors also who want to be good investors, start by looking at the cash flow statement. Try and understand that. Once you understand the cash flow, see, chartered accountants, CFAs, someone from BCom, he's taught to first draw the balance P&L, then the balance sheet, then the cash flow. But when you're evaluating a company, go exactly the opposite way. Evaluate the cash flows. The cash flow statements gives you enough story about what is actually happening. Then you go to the balance sheet and then finally look at growth on the P&L. Okay. If a company ticks off the cash flows and the balance sheets, then looking at the P&L makes a lot of sense. If the cash flows itself are dicey or the balance sheet is not strong enough, what our belief is, it doesn't make sense to go to the P&L.
So that's the process you follow. Yes. Start with the cash flows, then the balance sheet, and then the P&L.
Absolutely. So that's what I said at the starting. We try and avoid mistakes as far as possible. And this is a part of it.
So let's come back to India for a second. So you mentioned that you like to look at companies and sectors which are not doing well. So right now, if I evaluate the Indian stock market, what are those sectors which are going through a tough time?
This is a very good question again, So if I have to look at businesses which haven't done well, to give you some segments, subsectors also, I'll come to some interesting subsectors also. One reasonably good sector which hasn't done well but has invested heavily over the last 3-4 years and hopefully the numbers fructify is chemicals and agrochemicals. Agrochemicals, especially in the last 3 years, have gone through tough times. We believe the next year should be reasonably good for them. It was actually getting good. Unfortunately, the monsoons have been very erratic and hence the demand got depressed to a certain extent. But we believe that cycle is coming back where agrochemicals and chemicals both should start doing well. And this is also vindicated by the fact that if you look at China's 4-year policy that came through, they've clearly mentioned they don't want to grow commodity or focus on invest into commodity businesses, and chemicals, agrochemicals form a part of that commodity business. So the Indian companies have gone through a bit of a pain largely because there was a lot of dumping which has happened. Hopefully in the next 3-4 years, as sanity prevails and China starts focusing on more evolved businesses, this place of the dumping of chemicals and agrochemicals could actually come off. But having said that, this is a segment which we believe a large part of the competitive pain is getting over. We are going through the worst of cycle, and hopefully in the next 3 years the cycle comes back.
What about IT sector?
Yeah, that's the other one. I was coming to that.
Okay.
I think so. IT has gone through its own bit of pain. In terms of valuations have really corrected.
Because of the AI thing?
Because of AI, tech coming through, and hence the relevance itself of some of these IT companies.
Correct.
Plus the tariffs that were there and, the H1B visa, etc.
So the whole business model is low-cost labor.
Absolutely. It's
now,
an arbitrage.
AI coming in and tariffs,
right?
That industry is going to get affected.
Right.
So how could they possibly do a turnaround?
So see, I think so. This is something which we believe internally. One is India. It's unfortunate we didn't invest too much into some of these segments.
Yeah.
The upcoming, whether it is AI, etc. We just stuck to our model.
Correct.
Having said that,
you don't fix what's not broken.
Right. Exactly.
Unless somebody else makes it.
But having said that, our sense is they will still survive. The low-cost arbitrage thing will continue because AI will take its time of evolving to that extent. The pressure that is there in the US on H1B visa, etc., a lot of companies will actually start looking at outsourcing more to India because India being the low cost area. So to that extent, our belief is the IT industry might not be a super growth area, but it will be a far stable growth, good balance sheet, good cash flows, you'll make dividends. So this sector, excepting for some outliers, probably will still be able to grow at 14-16% and be able to pay you dividends.
Talking about stock growth or revenue growth, 14-16%?
I'm talking about returns will more or less mirror the earnings growth.
Earnings
to that
growth.
extent, yeah.
So let's go to another industry which you feel like there is some alpha to be made. Any industry that you can think of?
The other place where we think, consumption we believe should start coming back. Okay. It's gone through a good amount of pain. Some pockets out there can turn out to be interesting. Something that we probably will start, or we probably evaluating as we speak, is QSR. Okay, that's an interesting segment. Companies have invested, the stocks have got bombed out in the last 2-3 years because of food delivery companies they have taken. But I think where they have come to in terms of valuations vis-a-vis where probably over the next 3 years earnings can play out, and especially with the government focusing on pushing consumption to a certain extent. Also, mind you, the next year is when you have the pay commission revision also coming for the government employees, and they form a reasonable portion of consumption.
What does that mean, pay commission revision?
The government employees, every 5 years, they get a revision on their pays, right?
Salaries. Okay.
Yeah, salaries. And it's a big population out there. Okay. And they're a large market. Invariably, it's seen that they go ahead and spend. And the spend is usually discretionary consumption. And by discretionary consumption, it could be ACs, refrigerators, two-wheelers, four-wheelers, dining out. It could be anything that you can think of. Any consumption which is not required. But since you have money, you will go ahead and spend, is discretionary consumption. We see discretionary consumption starting to come back. And probably in some of those segments, probably it could turn out to be very, very interesting.
So for consumption to increase, for that the interest rates need to drop, and also the savings rate needs to increase, and also your salary hike should also increase. Don't you think all of these things are going in the opposite direction for consumption to increase?
No, so we are betting on the fact that one is salaries itself will increase.
But we don't see that a lot.
The pay revisions should drive that.
For government employees, I understand, but for private companies,
so that's true. But one thing which has actually positively impacted every household in India, literally, is the way gold has behaved. Indians have been savers, and a reasonable portion gets into gold. There has been a 50% appreciation in their wealth portfolio.
Right.
So it might not be monetizable to that extent, but what is happening is it gives you a good sense of security. Your sense of security has gone up. That is one. Secondly, when you go down the strata, there are a lot of people who actually borrow against gold. So to that extent, their borrowing power has gone up. 100 rupee against 100 rupee loan gold, they used to get 50 rupees, but today that 100 has gone to 150. So suddenly these people have access to 75 rupees worth of loans available. So that's a cycle which is actually playing out very positively in the lower strata of economy. And where you can understand, that's why the low ticket discretionary items is where the spending will happen.
Low ticket discretionary items is where the spending.
So you can define how low ticket could be. It could be anything, let's say, if you ask me, anything below 5,000 or 10,000 rupees. Okay. Anything that is not needed. So it would probably end up in buying probably a mobile of 5,000 or 10,000 rupees, or anything that you can think of in a low ticket side. You could define low ticket as 25,000. I could define it as 10,000. But anything which is not needed, but since you have this access, you'll go ahead and spend.
So right now, if I had to look at the 180 countries, and let's say you're not an Indian, right? And now I'm giving you the option, you can pick any country in the world to live. And the objective being making money. Which country would you pick?
Oh, that's a phenomenal question again. See, if I just look as an investor, okay, today, in fact, sitting in India, I'm allowed to invest across globally. Okay, you can invest anywhere. I think the differentiation is the taxation, right?
Right.
Okay, so in India, if it's capital gains, 1 year it's 20. Above 1 year it is 20%. 12.5%. If it is below 1 year, it's 20%. If it is overseas, it's 2 years. You have to have a minimum holding period. If I just look at the same market accessible to me from Middle East, I literally don't pay any taxes. That itself is a 20% arbitrage sitting out there for me. So if the whole market is accessible from any country, I would look for countries where the income tax rate or the capital gains tax rates are the lowest. And that itself will drive extra returns for me.
So let us say you are living in Dubai right now. You are managing a 1 crore personal portfolio.
Right.
Sitting in November 2025.
Mm-hmm.
How would you divide your money, knowing that you can invest in any of the countries, any of the sectors, any asset class, anything?
Sure.
How would you divide your money?
So we've been this is though we don't have any gold or silver funds, but personally, I mean, I've been advocating gold and silver for some time, and it's been more than a year. So probably the first thing is, where do we create enough safety in that sense? Probably gold and silver would take up 20-25% of the portfolio.
Right now?
Right now.
You put 20-25% in gold and silver?
Yes.
Wow.
Okay. That will be the first block where I'll place.
And in how much out of that 25% would be gold and silver?
See, that I would leave it to an investor, maybe 15, 10 or 10, 12.5. But gold would still be higher than silver.
So 25% in commodities, gold or
commodities. And we believe the debasement which is happening of paper currency, it is unbelievable. Right. If you think of it, a movement of gold by 50% basically means your dollar has debased by 50% in 1 year's time.
Right.
It's rarely happened. Okay. So that is something where at least I know my value of money is protected. Okay. Then I would pick up countries where probably my view and probably our view is commodities should start doing well. Okay. So countries which are more focused on or where you have commodity based companies, whether it is copper, uranium, gold, silver miners.
China is good with.
So you would have Brazil, South America probably. Okay, those are some countries. China is something that we like for tech and the pharma side, which is how it's evolving. So we like that segment. So, and we like India for consumption.
Okay.
We believe India, the size of the wealth effect of gold, the salary increases, etc. Plus, if you take a 5-10 year view, I think as the per capita GDP moves up, you will have consumption doing very well.
Right.
So that's how we would look at it. One country where we would be a little cautious about is the US.
So wait, just to take one step back.
Sure.
25% went in gold or silver. Right. Then you're like, okay, which are those countries which are good in commodity production?
Right.
You named Brazil. Why Brazil?
Brazil is probably very cheap. Okay. It's extremely cheap, and it is cheap because it's part of being, it's largely a commodity driven economy. You can take South America per se, oil and gas, commodities, etc.
So you would invest in the Brazil index or the Brazil commodities index?
So frankly, I don't have that expertise. So what I would do is I'd pick up a South America ETF.
Okay.
It's an easier way to do it. The ETF.
That's the broad market index of South America.
Yeah, absolutely. Or you pick up a Brazil ETF to a certain extent.
Okay.
You can do an ETF, put your money out there. Okay.
You say that is a good investment in today's time.
Yes. That is something that
because it's focused on commodities and anything else.
That's it. And the valuations are cheap.
Why is the valuation cheap then?
Because it's commodity driven and commodities rarely get values, frankly speaking. Okay. Now the thing is, the last 5-10 years, literally decade, you haven't seen a rally in commodities. If it happens, if there is a debasement of paper currency, you will invariably see real assets do well, and real assets would mean commodities doing well. Okay, we've seen the initial part come through in gold, silver to a certain extent, copper has started. Some of these commodities are well represented in the South American market.
Interesting.
Okay.
So how much money would you put in Brazil?
So that's very difficult. We've actually not thought through in that way, but it would still be about a 10%, 15% out there. Not Brazil, but commodity oriented countries, economies.
Okay. So
that would be about 30-35% go on between gold, silver and commodities.
Okay. So let me assume you put another 5-10% in Brazil.
Sure.
So 30-35% is done.
Done. Yes.
65% is left.
Right.
What countries are we looking at? What sectors are we
So-
looking at?
China would form the larger portion there.
What are you saying?
Yeah. So that would be another 30-35%.
You would put 30-35% of your money in China.
China specific to their tech and healthcare sector.
So I think it's what is that? Hang Seng
Hang Seng Tech ETF.
Tech.
That is one of the tech ETFs. There are quite a few ETFs. In India, we've got representation of the Hang Seng Tech ETF. There are funds which play a proxy as a fund of fund to some of these indices.
But tax efficiency would not be there.
Yes, that is why. So that you asked the right question. Where do you put tax efficiency is the thing. But see, frankly speaking, if you hold these indices for 2 years and you're taking a 3-4 year view, you hold them for 2 years, your taxation comes to 12.5%.
Correct.
Yeah, so it comes down dramatically. Having said that, that's why this will probably be a trade for the next 1-2 years. It's not a real long term. We'll have to see how the government out there evolves.
But 1 to 2 years, you're saying because the valuation itself is so low.
Absolutely. And your
It's
earnings are higher.
Huh.
You're getting at an index level, you're getting 20-24% earnings growth.
So if the earnings growth is higher, much higher than the PE multiple over here.
Absolutely.
So it's like a mathematics theory that it has to
Absolutely. So our only sense is, this is what we talk about, the concept of PEG. So the PE divided by earnings growth in China is below 1 and in India it's above 1.
Oh, if it's below 1, it's like
it's lucrative.
Just a certainty that it will be lucrative.
Yeah, it should be the place where you invest.
Interesting.
Okay.
Okay.
And then probably India, big.
So okay, 35% in China, so 30% is left.
Yes. And that
30% of your money is in India.
Yes. That would be probably where
consumption.
Yeah.
Consumption matlab could be FMCG, automobiles.
So there, see, that is where at least our expertise comes in. So we would probably move around sectors, segments, etc., looking for good businesses available at reasonable valuations. China, frankly speaking, we are not great experts. We understand the market, but if you ask us to pick stocks, we might not be the right team or right people to do it. Or at an individual level also. So we would rely on indices. We'll understand which segment is doing well. We'll put in money through ETFs out there. Okay. But in India, it'll come down to stock levels.
So which sectors specifically? Consumption mostly.
Largely, if you ask me to take a view on India in the next 10 or 15 years, segments which will, not short term. Let's forget, if someone really wants to build wealth over the next 5, 10, 15 years, I think consumption, healthcare. Okay, we are still a young population. Just think of it 20 years down the line as we start aging, how big healthcare can be. We believe defense, tech, etc. will also come through in the next 4-5 years. So that's another segment where we'll look at. Segments where we've stayed away over the last 5-7 years, and we probably will stay away, is financials, lending side of the business.
Really? You're going to be away from financial companies?
Yes.
But they form the biggest chunk of the index.
Yeah, so that's where your alpha gets created probably. The lending part. So financials include lending and non-lending.
But that comes under a bank stock.
Yeah, bank, NBFC, whatever. Anything that is lending.
So you will not touch that?
We've been big underweight for the last 6-7 years, and it has helped us create alpha.
But why do you think that the banking sector will not grow as fast?
See, our only sense is...
because the reason I'm asking this question, the way I'm thinking about it,
sure,
is that India is a credit-hungry country.
Right.
The need for money is always going to be there.
Right.
But the need to buy houses and cars is always going to be there. And more people, like you said, the GDP per capita of the country is increasing. So that hunger to do a lifestyle upgradation is there. So I need to buy houses and cars, which is going to take the biggest wallet share.
Sure.
It's almost impossible that all of these Indians can buy these things outright.
Right.
So by that logic, don't you think that, and we are a young population also.
Right.
So by that logic, don't you think that the banking sector should flourish?
So let me put it this way. We like any sector which is consolidating, where the number of players are actually coming down. We are wary about any sector which is fragmenting, where the number of players go up. Because once a sector starts fragmenting, your pricing power goes down dramatically.
But RBI is not giving away more banking licenses, no?
But if you think of it, the number of lenders have gone up through the roof in the last 10 years, 5 years, 7 years.
How? Can you give an example?
Number of banks have come through, small banks, MFIs, okay. Then there were Paytm wallets which came. Then the evolution of, buy now, pay later, fintechs. So it is just not banks. The access to credit
Correct.
has gone up dramatically.
You're right. Today, most fintech companies have gotten into personal loan lending.
Absolutely.
That's the biggest part of their revenue.
Absolutely.
Like credit, for example, I think almost 2,000 crores of revenue comes from lending.
Absolutely. So the competitive intensity is extremely high there. Okay, that is one. Secondly, this is only a personal side. Now you think on the corporate side or the lending side to corporates, etc. What is very, very surprising is India, the way corporate India has deleveraged or reduced their balance sheet debt in the last 5 years, it's phenomenal. I'll give you statistics. When I look at the small and mid cap segment in India or the small and micro cap segment, okay, their balance sheets today are cleaner than the large and mid cap put together on a debt to equity. So that means corporate India is extremely deleveraged. They don't have debt. In fact, a lot of segments have cash sitting out there. Now, if you have got cash sitting out on a balance sheet, why would a company borrow? They've got their own cash. In fact, the banks are pained because they'll have to pay interest on this money which is lying with them. Okay. But these banks, when they need money, they actually don't go ahead and borrow from the banks. They use their own balance sheet strength to go ahead and do capex, etc. The second thing that we are observing very, very clearly, corporate India is a little wary about taking debt. So they go ahead and dilute equity, the listed guys at least, to do whatever capex is needed, and then they fund it through internal accruals. So on the corporate lending side, the growth is also subdued. So competitive intensity, low growth on this side is something that we believe the ROEs will not expand. It is very difficult just because of pure competitive intensity. And the third part of it is last 1 or 2 years, the banking balance sheets are pristine today in terms of how clean it is. In a cycle, it can only get dirty from here. Okay, so the NPA cycle starts picking up over a period of time. So in such a case, it becomes very difficult for me to justify. There would be trading buys and sells once in a while here and there. But over a period of time, can financials actually, lending, I'm not talking the non-lending part, the lending financials, can they go ahead and create wealth for you? Very unlikely.
Wow, this was my favorite learning so far of this conversation. This is a very, fresh approach towards how do you evaluate the banking industry. I didn't think about these aspects.
Sure.
Thank you for that.
Oh, my pleasure. Just think of the large banks that you can think of, even on the private sector side, and just look through their price charts. You'll realize what I've said last 5-7 years, it's gone nowhere.
So you're saying banking sector you will not look at the consumption sector and
look at the non-banking financial sector.
Non-banking financial sector could be companies like
related to the market, equity markets, anything related that value chain of exchanges, RTAs,
NSE kind of companies.
Yes, anything. It could
brokerage
be
companies.
For
example, Grow is doing IPO. By the time this podcast goes out, Grow IPO will be out. But what's your opinion before it goes out?
So, without naming any company per se, I think brokerages can be very interesting for some period of time. But
regulatory risk. Regulatory risk is definitely there.
So, our favorite segment where we would like to focus on in that full value chain, which is on the non-banking financial, would be wealth management companies.
Correct.
If you think India has to grow and the Indian wealth.
So it looks like I've set up the right business.
Absolutely. I think that's a segment which we believe will do very well. I'll give you an example. In Hong Kong, I barely made it to a level where, the bank wealth managers would even talk to me. But they were so proactive. They would realize that this is a guy who's probably going to touch the point at some point.
Right.
And they'll proactively start touching you there. Okay, I think that phase will come through within India also. They start early and the growth can be immense because Hong Kong went through its own per capita GDP hockey stick impact. We believe the next 5-7 years, India will see that.
So what kind of specific companies in wealth management do you like?
Wealth management companies, basically.
Like, what is their business model usually?
Oh, anything. It could be basically identifying people who would probably have wealth built on there and then handhold them in managing their money. So you've got wealth management companies listed in India. Okay, depending on who looks at what segment. Some could look at very premium segments. Some could look at mass affluent. Okay, but it could be anywhere. But these are segments which we believe in the next 5, 10, 15 years, if run well and managed well, they can actually generate a lot of wealth for.
Impressive. So, all right. So this is the Indian story that you like. Now, you said you'll be very wary of the US right now. So you would not touch US right now, the US market, zero investments.
So our sense is, if I take a 5-year view, no doubt US will probably continue to do well. But today valuations probably we'll have to look at where it is. The second thing that worries me is basically the interest rates out there. And this is a worry for general equity as a class, because whatever said, our sense is the 10-year yields are a true reflection of where inflation is.
Okay.
So US actually cut interest rates, but the yields have moved up. Okay. And our belief is if spending continues in the US, the government spending continues, it will be inflationary. And hence, this is the Fed chairman also saying, we'll have to be wary about whether we'll go ahead and cut in December again or not. Okay. That is basically reflecting the fact that he's concerned about inflation. If inflation comes,
why is US spending so much? Why they can't stop spending?
I don't know. The US problem is a problem. I don't have an answer to how do they
This is the
resolve.
first time you said I don't know in this entire conversation. So,
No, so this is a problem which I think the bigger economists don't have a solution to it. How do you resolve the US debt issue? Okay.
So basically they're spending for the debt.
Yes,
Debt
they are
repair.
spending. They're trying to spend themselves out, grow themselves out of the debt problem. If possible, whether it is through revaluation of gold or whether it is through spending out there. But our sense, we don't have, the world I don't think has a solution to this. We'll have
So
to,
do you think there is a certain probability that the US market could collapse?
see, I wouldn't want to say it that way. But can the markets go down 10-15% or 20%? Can there be a correction out there? I think so, yes. And if the US corrects, I think the world will also correct to a certain extent, plus minus, okay, depending on that.
So now let's come to the products that you manage. You have a PMS and an AIF.
Right.
Now, anybody who has less than 2 to 3 crores of net worth will not be able to buy a product like yours.
Sure.
So my question to you is, once somebody has a 5 crore, 10 crore net worth, meaning they become a millionaire in terms of dollar terms, that is when they start looking at new products beyond the vanilla mutual funds and so on and so forth. FDs, mutual funds, US market, everything they have done, now they are coming to you.
Sure.
So what exactly are you guys able to do in your exotic products like a PMS and AIF, which helps the HNI investors make an additional alpha? So what exactly are you guys doing which is different from the world of mutual funds?
See, I'll tell you, frankly, if you ask us, we fish in the same pond. Okay. It's the listed equity side.
But maybe you go a little deeper.
We go deeper, we try and differentiate. I think the big differentiator is what portion of the AUM gets allocated to stocks. I think on the mutual fund side, mutual fund side, you've got investors who invest as low as 500 rupees in an SIP. Okay, he's not looking for that extraordinary returns. He wants reasonable amount of safety with good alpha growth happening out there. Whereas an HNI is ready to take those risks. And how does he take those risks? He goes down the market cap probably. He says, okay, Aniruddha, I'm okay with you holding 15%, let's say, or 20% in a single stock. Those are the that is where your bets go right. You've done enough research. The alpha generation can be humongous. Okay, and that is where we differentiate largely from.
You can have 15% in a single stock also.
Yeah, in a PMS, there is absolutely no restriction. You can go up to 25, 30%. In an AIF, yes, you have a restriction of 10%. Anytime it moves beyond 10%, you will have to correct it back to 10%. That is the regulation for the AIF. Okay. The PMS, there are no regulations per se as to what portion of an AUM should be in a single stock.
Also, I think as a mutual fund, I cannot purchase more than 10% of a stock also, right? There's a restriction.
Of the company.
Of the company, yes.
Right.
But does the PMS have that restriction?
PMS, I don't think so that has this restriction. No. Anyway, it doesn't go to that level also. But our sense is at an individual's portfolio level, I can go beyond 10% in a single stock. So if you give me,
are talking about customized PMS approaches.
Absolutely.
That's what you do.
Not only customized, that could be the way forward where I could say, okay, I'll build a portfolio for an investor with only 5 stocks.
Okay, I thought you have like a common product for everybody.
No, there are fund houses or PMSs which do that. off-the-shelf products.
Right.
But our belief is when an investor is giving us those kind of checks, it becomes imperative for us to go ahead and create a differentiation. If I give him that same portfolio, if he comes today and 6 months down the line and 1 year down the line, then I'm not doing justice to him.
So basically, you create a custom approach for everybody who comes to you.
We try and do that within a period of time. If the stocks have not moved, it is largely, the team largely goes and creates that portfolio. But as prices move, we try and then start looking for, over a period of time, the commonality starts reducing among portfolios because prices have moved by then. If the prices haven't moved, the portfolio stays the same, more or less.
That's a very interesting point because in mutual funds, a mutual fund manager cannot do that.
Yes.
Because even if the portfolio has performed well,
right
now a new investor is coming and seeing that the
he
portfolio
buys
has
the same
well.
thing as an NAV.
He buys the same thing as an NAV,
right.
but it could be the top of that cycle.
Yes,
it could be.
Yes.
And the mutual fund manager doesn't have the time to tell, hey, stop, this is not for you right now because I'm not assessing your personal risk portfolio and all of that.
That's true, but there have been people in this industry who've been very vocal also that this is not the right time to buy into this segment of the market, etc.
Yeah, but rare such people.
Yeah, absolutely.
They're not very.
Yes, but our sense is yes, there are limitations to what a mutual fund, and that is where probably the PMS also or an AIF has the liberty to take cash calls also. Go up to 20-30% kind of cash sit out there.
So mutual fund managers can.
I don't think the mutual fund managers have that. So if it's a large cap fund, you anyway have to be 80% large caps. Okay, so you have to be minimum 80% invested. So those restrictions are there from the regulator, which probably is a little more, you have got a lot more leeway on the PMS and AIF side.
So before I continue on this path, I had one question which I was reading online, which is that what the media is saying right now, that PMSs, for all its sophistication and investment strategy and premiumization, has not beaten 90% of the mutual funds. That's the headline. Is this the right way to process this news? Because like you said, there is some PMSs which are a common product for multiple investors, or you create a custom PMS for every investor. So when a headline like this comes out, where 90% of PMS fund managers have underperformed the benchmark, underperformed the mutual funds,
right?
How do I really process this kind of a news?
I think in the last 3-4 years, the number of PMSs which have come through, I mean, they have, it's been overwhelming.
Around 300-400 are there, no?
I think it's even more. Okay. It's been overwhelming.
Okay.
Now, interestingly, I won't say fund managers have not, PMS fund, there are fund managers who have done very well in 1 year, 3 or 5 year, beaten index, beaten this thing. So that's not an issue. I think with more number of PMSs opening over the last 2, 3, 4 years, there are a lot of people who have not seen a business cycle or a market cycle. They have seen the positive side. I think the true test for a lot of them will come through in a down cycle of how you are able to protect the downside. And that is where I believe not just for the PMS side, for the mutual fund side also, that test will come through in terms of how you protect downside. On the PMS side, I think so there are reasonably good fund managers who've been able to pick funds, pick stocks, and do very well over the last 1, 3, 5 years. So maybe it's just because of a lot of fund managers who haven't got that experience, or they've come through in the last 3-5 years in a bull market cycle where things haven't played out the way it should have played out. Then there could be many reasons. People are not convinced with the rally, hence being defensive. There have been people who have carried cash, and once you carry heavy amount of cash in a bull market, you start underperforming. So these are cycles. But I think the real test of a good investor, whether it's a fund manager, PMS, AIF, whether it's a retail investor, is how well you protect downsides.
Which is the current situation we are probably in.
We are still not on a downside.
We're not in the downside, but it could come.
Yeah, if it comes, I'm just saying, let's say if the markets correct 10%, okay, and small and mid caps correct 15%.
But that happened 6 months back.
Yes, 6 months back.
Yeah.
So probably that would be a nice place to go and see how funds have done, and that was a very short, that was a V recovery.
Yes.
Literally a V recovery, right? Our
Not
sense
this, I
is,
think almost a year back. No, November it happened. No, last year.
no, February, this time February, March it happened.
Okay,
Then
correct.
that the conflict and all those sort of
Yes,
things
yes,
came
yes.
through, and then there were tariffs, etc. Those announcements. So our sense is, if the markets go down for 3-4 months, a quarter, or 6 months, with a correction of 10-15%, I think the good fund managers will be the people who would be able to protect the downside. And protecting the downside would basically mean your companies have the wherewithal or the fundamentals to stand up to the valuations where they are.
So that is the true skill.
Absolutely.
So you mentioned that you create these customized PMS portfolios. Let's say I come to you.
Right.
I give you, let's say, 1 crore.
Sure.
How does that process work? How will you help me?
No, so basically, we will not do anything very different from what, let's say, a mutual fund manager does. The difference is a mutual fund manager, actually, it gets invested at an NAV completely.
Correct.
For us today, when you give us money, we will be very selective about what we go ahead and buy. How much would be the allocation? We could sit on 20% cash for you or 30% cash for you.
So yeah, that's what I want to ask. Right now, as we speak, how much percent cash would you? Let's say I give you 1 crore, you will say how much percent
We
cash?
would want to hold on to at least 25-30% cash today.
Wow.
Yes.
So that's similar to what Warren Buffett is also doing right now.
I think so. He's a far senior guy.
Huh.
And I think so he holds a lot more cash, actually, if I'm not mistaken.
Almost 40%.
Yeah. So whatever it is, but our sense is, if I look at a macro perspective, I would want to hold on to 20-25% cash for you.
Good. What is the highest returns you ever gotten in a single stock that you've invested? You're like, you did all of this research, you invested in that stock. What are the highest returns you made?
I don't even know the calculation. Initially in DSP Microcap, we bought an NBFC based out of Pune at 50 rupees pre-split pre-bonus.
50 rupees?
Pre-split pre-bonus in 2009.
Okay.
Okay. And it is today the largest NBFC in India.
Okay.
So that's the answer.
Wow.
We were the first mutual fund to buy it, and I was managing that fund at that time. It was destiny, actually. Even today I would say that, because that was not a meeting which was scheduled for me. Unfortunately, a meeting got cancelled, and that meeting came in as a substitute at that point in time. And it was an amazing business that I could understand. Okay. We came back, the next day we went ahead and bought it.
So, Aniruddha, you clearly love your job, right?
Absolutely.
You would do this for free also for the rest of your life.
Yes, I'm
right?
Very happy.
You live and breathe this. You live and breathe the capital markets. So my question to you is, for somebody who's on the capital market side, who lives and breathes that space, not just of the Indian market, you look over the world, right? And you said that you are somebody who reaches office by 7:30, 7:45 a.m.
7:50, yeah.
You go there and nobody's in the office and you're just reading Bloomberg and understanding everything that happened in the world while you were sleeping.
Sure.
You're that kind of a person.
Sure.
Do you ever venture into real estate, anything of that sort of your investment? Would you ever get into real estate?
So, frankly speaking, that's an asset class which I professionally don't have an expertise on. Having said that, yes, I have gone ahead and booked my first one property. I'm still staying on rent.
Okay.
It makes a lot of sense today.
Wow. You're 50 years old.
Yes.
You're staying on rent.
Yeah. Because yields in Mumbai.
And you're a CIO of one of the largest AMCs in India.
So that's how it's been. Still staying on rent. But of late, I've just crossed 50. So my wife made me realize I need
That's
to
the same answer I hear from every CIO who has come here.
Okay.
My wife finally told me you have to buy a house. So now I bought a house.
No, actually, no, it's not yet been delivered. It's going to come through probably in the next couple of years. But yes, still now, frankly speaking, I've been staying on rent through my life.
So you mentioned something about the yield. Can you just explain that?
So if you just look at the prices today, okay, let's say you've got it's a flat which is 5 crores. You finally end up paying a rent of, let's say, 1 lakh per month. So you're paying a 12 lakh rent on a 5 crore. You know what the yield is?
2.1%.
So, yes. Instead of buying that flat for 5 crores, I go ahead and invest that 5 crores into a FD also. The yield actually on an FD post-tax will probably match the yield of the rental yield. So why? I mean, if I just look purely from financials perspective,
yes,
it doesn't make much sense to actually own houses, frankly.
Perfect. Aniruddha, I think that was a fantastic masterclass for me.
No, thank you.
What I should do with my money. for 2026.
Sure.
I got a lot of very, very eye-opening insights
Sure.
as to how to analyze my capital allocation, not just for the Indian markets, but from across various asset classes.
Sure.
Thank you so much. Your
My
knowledge
pleasure.
is unlimited, but I think we've reached the 2-hour mark.
Sure. You've been very gracious. Thank you very much. It was lovely speaking.
Thank you so much for agreeing to come here. And
My
I know
pleasure.
it's very far for you, BKC. Thank you so much.
Thank you.
And I hope to see you again soon
Sure.
when something, either something great happens in the market or something bad happens in the market. You'll be the first one I call.
Sure.
Thank you so
Perfect.
much.
Thank you.
Okay.
My pleasure.
Bye-bye.
Thank you very much.
All right, guys, that brings us to the end of our conversation. Please go down and put in the comment section what was your favorite part of learning here. And if there's any question that you felt like I should have asked but did not ask, please put that down as well so that I know what you guys are thinking. And like always, do not forget to smash that like button and share this with your entire WhatsApp groups. On that note, I'll see you in the next one. Before you go, guys, if this episode gave you even one insight that made you think differently about money, don't just keep it to yourself. Share it with your friend or family member who could use it too. And if it sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make these conversations sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with at least one new thing every Wednesday.